Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. What if I tell you that if history is any guide, Tata Motors, one of the best performing auto stocks of this bull market, could fall anywhere between 30% to 40% in the near future. Or Tata Power, again a Tata Group company and one of the best performing power stocks, could fall as much as 50% if you go by the stock's historical performance. Or what if I tell you that Titan Company Ltd can still give good returns from here even though it is 50% more expensive than in the past? I know you will demand evidence, right? Well, I certainly give you the evidence, but first let me shift your focus from the Tata Group to the airfields of Israel. You see, back in the 1960s, Daniel Kahneman, a future Nobel Prize winner in psychology, was addressing a batch of flight instructors. He was teaching them about how to produce better Air Force pilots. Now, Daniel Kahneman told the instructors that in his experience, rewards work better than punishments when it comes to skill training. So Kahneman advised that if they want to improve the skills of their pilots, then the flight instructors should rely more on positive reinforcement and praise than negative feedback or punishment. Kahneman told them that when he tested his theory on both animals as well as humans, rewards gave better results than punishments almost every single time. However, one of the flight instructors objected to Kahneman's findings. He said that in his own experience, punishment and not reward worked better on most occasions. He further added that whenever he criticized a pilot after a poor flight maneuver, he performed well in his next maneuver, and whenever he praised a pilot after a good maneuver, he invariably did worse in the next round. So in his own experience, punishment led to a better performance and criticism to a poor performance. Soon, other flight instructors present there also joined him and nodded in agreement. Almost all of them felt that Kahneman's findings did not work with them. Their own experience was completely opposite to what Kahneman was teaching. Well, trying to find an answer to this paradox led to one of the biggest eureka moments in Kahneman's life. Kahneman soon realized that the flight instructors were indeed right about the pilots doing worse after receiving praise and doing better after receiving criticism. He, however, concluded that the instructors were wrong in assuming that it was their praise or criticism that led the pilots to put up a worse or a better performance. In fact, the performance of the pilots can be much better explained through the principle or the theory of reversion to the mean. You see, the average or the mean performance of the pilot is made up of a lot of different performances. So if during a particular flight, a pilot has done way better than his mean performance, his next performance is likely to be worse or closer to the mean performance. Likewise, if during a flight the pilot has done way worse than mean, his next flight is likely to be much better and close to the average. And this is exactly what was happening when the pilots that these flight instructors were training. Whenever they put up a very good performance, the next flight would invariably be worse. The flight instructors thought it was their praise that was causing them to underperform in the next flight. However, it was just a simple statistical principle of reversion to the mean at work. Likewise, when a pilot improved his performance after a below par round, the instructors thought it was their criticism that led to the better performance. But here again, it was reversion to the mean at work. This delightful story has been taken from Kahneman's best-selling book, Thinking Fast and Slow. Kahneman is of the view that the phenomenon similar to what happened with flight instructors is extremely common and happens all the time. In fact, in my own career, learning about reversion to the mean was one of the big turning points personally for me. It helped me see investing in a new, far more useful light. Now, I told you at the start of the video that Tata Motors may come under selling pressure in the near future. Well, my call was based on this very principle of reversion to the mean. As you can see, I have collected data over the last 10 years, that is between September 2012 and September 2022. Tata Motors has traded at an average consolidated price to book value multiple of 1.7x over the last 10 years. However, its current price to book value is close to 3 times. Now, the reason I'm considering price to book value and not price to earnings is because capital intensive and cyclical industries like auto need to be valued on price to book value and not price to earnings. There are some industries where price to earnings work better and some industries where price to book value works better. I think for a company like Tata Motors, price to book value is a better metric. The average 3-year CAGR for an investor who invested in Tata Motors over the last 10 years and who paid a price to book value multiple of less than 1.7 times is 5% per annum. In other words, if you would have bought Tata Motors any time over the last 10 years such that your holding period is 3 years and you paid a price to book value of less than 1.7 times, you'd have made an average CAGR of 5%. However, if you bought at a price to book value of more than 1.7 times, then our average CAGR falls to negative 9.5%. You would have lost money on average if you would have paid more than 1.7 times. This is nothing but reversion to the mean at work. You buy below or close to long-term average and you earn positive returns. But if you pay more than the long-term average price to book value, your average returns are in the negative. In fact, a great time to buy Tata Motors in the last 10 years has been a price to book value multiple of 1.2 times. Whenever you paid 1.2 times or below, your average 3-year CAGR stood at an impressive 22.5%. So if history were to repeat itself, a good time to buy Tata Motors is when the price to book value falls to 1.2 times or below. Right now, the stock trades at close to 3 times its book value, which is high in my opinion, and based on reversion to the mean indicates that the stock price could be in bubble territory. Let us take another Tata Group company, Tata Power. Like Tata Motors, Tata Power also needs to be valued on price to book value, and like Tata Motors, Tata Power also had an average price to book value of 1.5 times over the last 10 years. And investors who bought at or below this multiple earned 16.9% CAGR for a 3-year holding period on an average. However, those who bought at a book value multiple of more than 1.5 times, they've had to suffer negative CAGR of 6.3%. Right now, the stock trades at a book value multiple of 3 times, which is twice its long-term average. So based on historical multiples, Tata Power is another stock where there seems to be a bubble present. Let's consider the third Tata stock, that is Tata Steel, which is also capital intensive and hence needs to be valued using the price to book value multiple. Here, there is some good news. The stock is actually trading at a small discount to its long-term average price to book value multiple. As you can see, the average price to book value multiple is 1.1 times book value, which historically has led to an almost 17% average CAGR over 3 years. However, paying more than that has resulted into the CAGR falling drastically to just over 3%. If history is anything to go by, investing in Tata Steel at the current price does seems to have a risk-reward ratio that is in favor of the investors. Here's another Tata Group company, TCS, and the biggest and the most valuable of the lot. For TCS, we are going to consider PE ratio since this is how you should value IT companies. Over the last 10 years, TCS has commanded an average PE multiple of 22.6 times, and investing at or below this multiple has fetched investors an average CAGR of 21% over 3 years. However, paying a PE multiple of more than 23 times has led to the returns significantly falling to 12.8%. The stock currently trades at a PE of almost 30 times, which is significantly higher than the long-term average, and which means that the stock may well earn a CAGR of around 10% or thereabouts if the future is exactly like the past. Please note that the PE of TCS had gone to as high as 40 times back in October 2021. The stock therefore is already down 25% from that price. Why? Well, the PE of 40 times was like that performance of the Air Force pilot that was way better than the mean. Eventually, the performance had to fall back down to the long-term average, and this is exactly what happened. I won't be surprised if there's some more correction in store for the stock. Let's move to the fifth and the final Tata Group stock in our study, Titan Company Ltd. Here again we are using the P/E ratio as that's the right way to value a stock like Titan. Over the last 10 years, Titan has commanded an average P/E multiple of 50 times. However, right now the stock is trading at a 160% premium to that. That is a PE of almost 80x. Historically, buying Titan at a PE of 50 times or below has proven to be a wise decision, resulting into an average 3-year CAGR of 26.6%. However, buying at a PE of more than 75 times has led to the returns falling to 18.6%. Therefore, while the stock is quite expensive as compared to average valuation, the future returns could still be decent if history is anything to go by. Now, if I were to summarize, we looked at 5 major Tata Group companies which together account for more than 80% of the total market value of the Tata Group. Out of the 5, I think only Tata Steel is trading at close to its long-term average valuation multiple. The other 4 are all trading at a premium, with the premium being particularly high in case of Tata Motors and Tata Power. And it is these 2 stocks that have the highest possibility of being in bubble territory and therefore vulnerable to a significant price correction in the near future. I know what you're thinking. You must be thinking that I have only taken into account the historical valuations and not touched upon their future potential or future earnings growth. What if all these stocks have a very bright future ahead of them and therefore deserve the premium valuations that they are trading at right now? I think this is a very valid point. However, there are a couple of things that I'd like to highlight in my defense. I believe that reversion to the mean is a more powerful force than breaking away from the mean. Most stocks tend to mean reverse, especially from mature and competitive sectors like auto and power, and hence betting on reversion to the mean is likely to yield better long-term results than assuming that a higher PE multiple or price to book value multiple is here to stay. Applying this principle to overvalued stocks like Tata Motors and Tata Power implies that there is a great possibility of these stocks getting back to their long-term averages than staying at elevated levels for long. Secondly, you don't want to invest in a stock where the outlook is supposed to be bright. Such stocks are never available in the market for cheap, and you have to pay a premium if you want to buy them. History suggests that you cannot do well in the stock market if you consistently pay a very high PE or price to book value multiple in the hope that the future is very bright for the stocks under consideration. In the stock market, uncertainty is your trusted friend, as this uncertainty often leads to valuations that are well below the long-term average and often lead to reversion to the mean working in your favor. Therefore, in conclusion, while not all of the Tata Group stocks could be in a bubble, there are a couple that you need to be wary of. These are the ones trading way above the historical valuations and are most at risk if the all-important principle of reversion to the mean is anything to go by. This brings me to the end of this session. You can conduct a similar analysis on other Tata Group companies to see how far they are trading from their long-term average multiples. I'm sure you will come up with some interesting findings. I'll see you again next time. Goodbye and take care, and a humble request to share and like the video in case you found it useful.